Good morning. Time now a minute after 8 o'clock in the morning in Tokyo, Friday, April 22nd, 2022. Welcome to another edition of the online morning seminar organized by the World Bank Tokyo office. My name is Koichi Omori. I am Senior External Affairs Officer of the World Bank based in Tokyo. We organize these online seminars to introduce the latest report in timely manner with the World Bank economists and specialists as our speakers. Every spring and fall, regional chief economist offices publish regional economic update, capturing the economic trend and key topics with deeper analysis. In the morning seminar, we are planning to introduce all of the 6 regional economic updates. We already featured East Asia and the Pacific region last week. This week, Europe and Central Asia. Joining us from Washington, we have Colette Mary Wheeler, Senior Economist in the Prospect Group of the World Bank. Colette is especially focusing on the Europe and Central Asia region in the group, closely working with the Office of the Chief Economist, Office of the Regional Chief Economist for Europe and Central Asia region. Colette, good evening to you. Thanks for joining. Can you hear me?
Thank you, Koshi. It is a pleasure to be with you today. And good morning, Tokyo. It's really an honor. I'm excited. Thank you.
Great, thank you very much. We'll listen to Colette for the next 35, 40 minutes, presenting the main point of the latest edition of the Europe and Central Asia Regional Economic Update, titled The War in the Region, released on the April 10th. Following her presentation, I'll read your questions, and thank you very much for sending the question in advance to us. If you did not have opportunities to send your question in advance, please do so using online form posted on the announcement page of the seminar, or you can simply post your question on the chat section of the YouTube screen. I'll read your question after keynote presentation by Colette, asking her to respond. With that, I'd like to ask Colette to come in to start her presentation. Over to you, Colette.
Thank you so much for the warm welcome again. All right, so to kick it off, so as a backdrop, prior to the war, we were already bracing for a sharp growth slowdown in the Europe and Central Asia region, which I will call ECA from here on out. And when I talk about ECA, I'm talking about the emerging market and developing economies in ECA. So as I mentioned, we were already ready for a growth slowdown after growing at 6.5% last year, a strong rebound from the pandemic. We expected that growth would slow to about 3%, so about half the pace that it had achieved in 2021. So reasons for this was that the region was having to contend with a far less favorable external environment. And this is even before the war. We had slowing global trade, tightening global financing conditions, and weakening euro area growth. And moreover, domestic headwinds were also dampening the outlook, especially as high inflationary pressures and debt prompted tighter macroeconomic policy. The region was already struggling to attract investment flows. This was largely due to high policy uncertainty, and certainly in some large economies such as Turkey, as well as heightened social unrest and geopolitical tensions in the eastern part of the region. And moreover, the recovery from the pandemic had not been complete or even at all. And then the war broke out. And so, what we've seen so far is first and foremost that this has caused a humanitarian catastrophe. It's triggered the fastest growing refugee crisis in Europe since World War II. It's estimated that about a quarter of Ukraine's population is displaced, 5 million as refugees, most of which are women and children, and 7 million internally. And then about half of Ukraine's businesses have been forced to close as a result of the war, and the rest that remain open are operating well below their capacity. The war has also caused physical destruction. It's forced many businesses not only to close, but it's also damaged key, vital, critical infrastructure to the economy, such as bridges, roads, arable lands for wheat production. And it's caused a lot of disruption on the trade side. And so, putting all these factors together, we're expecting Ukraine's economy to have this year alone. And then turning to Russia, which is the region's largest economy, the country has essentially been cut off from the global financial system. It's now the world's most sanctioned economy, with about 75% of its banking sector facing some degree of restrictions. The most damaging among those sanctions have been those on the Central Bank of Russia, particularly with half of their assets of international reserves frozen. These sanctions have impaired Russia's macroeconomic buffers, and they forced the CBR, the Central Bank of Russia, to impose capital controls and to hike the policy rate. The sanctions have also increased the burden of external debt servicing costs, making it really difficult for Russia to meet its foreign debt obligations. And in fact, the country entered default in mid-April on some of its foreign debt. So as a result, we've seen the economy plunge into a deep recession, even looking at the high-frequency indicators. They're falling to lows that we haven't seen since the height of the start of the pandemic. And so we're expecting about an 11% contraction in Russia, largely driven by a collapse in domestic demand. And it's really hard to see Russia to be able to recover from this, at least not in a robust manner. They'll be starved of critical imports. And import substitution, they might be able to do, but only to some extent. You know, the Russian economy is not as competitive, open of a market as other economies in the region. So this will be a challenge for them. They also could get some imports from other countries. This is true, but these are not the critical high-tech semiconductor imports that they'll really need to be able to keep certain industries growing and operating, such as those related to avionics. So there are a lot of challenges going forward. And not only that, the war is coming at a time, as I mentioned, when the global economy was already vulnerable. The recovery was already slowing. And even though the Russian economy is small globally, think Canada small. A double-digit contraction in Russia, even if it had no repercussions elsewhere, would arithmetically reduce global growth. But it does have repercussions, especially for global commodity markets, where both Russia and Ukraine are massively overrepresented. And we have already seen this play out to some extent. And of course, as mentioned here in the slides, there are other channels other than commodities, also through trade, finance, tourism, and migration. But before I dive into these individual channels, I wanted to mention the most important ones that we see so far for the ECA region. And that is largely through higher commodity prices and slower euro area growth. And of course, higher commodity prices and supply disruptions are further complicating this very careful balancing act that policymakers are having to do. And so first turning to commodities. So as I'm sure you're aware, Russia is among the world's largest energy exporters. But Russia is also an important player for global palladium and nickel production. Both commodities are critical for industrial inputs. Palladium is used in catalytic converters and car production, while nickel is used in steel production and construction. Now, Ukraine plays a smaller role in terms of industrial commodity exports, but it's really important for certain sectors, such as automobiles, which are highly dependent on Ukraine, especially in Western Europe, for some pretty niche inputs. So, for instance, wiring systems. These are not things you would normally hear about, right? But the assembly lines rely on these. It's the central nervous system. And Ukraine alone accounts for about 10% of the EU's supply of this part alone. You might think that, okay, well, perhaps it's substitutable, but it's not that easy. Production wiring systems are unique to each car model. Vehicles simply cannot be built without them. So this war has really sent suppliers scrambling. And as a result, we've already seen additional delivery bottlenecks and some car lines having to shut down production lines. And then, of course, on the agricultural side, we are really concerned about the war's ripple effects. Both Ukraine and Russia are large agricultural exporters, especially for wheat. Together, they account for a quarter of global wheat exports. And as you can see, prices on the right side of this chart, they've risen sharply for those commodities that Russia and Ukraine are key exporters of. But obviously, there's been a lot of volatility, as you can also see. And for several countries that import these commodities, that's particularly bad news. And it's probably only going to get worse before it gets better, unfortunately. So, a key consequence of this war has been its implications for food security. Russia and Ukraine collectively account for more than 75% of imports of wheat in numerous countries, including those in ECA, in MENA, and in SSA. This is really bad because the war has meant that trade in Ukraine has essentially been halted. Grain-laden ships are no longer leaving Black Sea ports, and that's where 90% of Ukraine's grain exports are shipped from. Ukraine's harvest of winter wheat is being disrupted, and spring planting is likely to be too. And this could have ripple effects for the next year or so. And then if you could think, well, Russia can ship out, think again. Russian cargo has been arriving somewhat erratically to trading partners. They've been struggling because Russia ports will, or insurers will no longer insure these ships leaving Russian ports, or they're having a very difficult time too. And still, even in the cases where they are being insured, counter sanctions announced by Russia has also slowed things down, including the tighter licensing quotas on wheat, rye, barley, and corn. And this can also hinder supply, especially if it keeps in place. And additionally, it's important to remember that wheat is not easily substitutable. Unlike corn and soybeans, wheat is not. It's also important to point out that Russia and Belarus, who is also under sanctions, including for fertilizers, are huge fertilizer exporters, and prices were already soaring before the war because of natural gas increases. It's a critical input into fertilizer. And so the war is likely to push up input costs for agricultural production even more. This is especially bad news in low-income countries where agricultural output is already held back by high fertilizer prices. So really the near term looks bumpy and could raise food insecurity, which is a very big problem for our client countries. And then turning back to energy. Energy disruptions are a huge challenge and risk from the war. Given Europe's heavy dependence on energy imports, particularly from Russia, if the supply cutoff to an escalation in conflict, for instance, happened, euro area growth could be cut by 3 percentage point, according to some outside private sector estimates. Since the euro area is ECA's largest trading partner, this would be really damaging to the regional outlook. And of course, there is the possibility we could see some trade diversion with crude oil and coal, but it's really tricky for natural gas to be redirected given the infrastructure challenges and that a lot of terminals have been at capacity or close to it leading up to this war. Even on the oil side, which is a bit more easy to trade than natural gas, there are still huge supply constraints. There was limited capacity in crude oil prior to the war, with the exception of perhaps of Saudi Arabia. And the situation, at least in the region, has also been further hampered by disruption to Kazakhstan's main pipeline from a storm in March. And that will take a bit of time for it to get back online fully. So there's a lot of downsides here. And so, of course, Russia and Ukraine, they're big on the commodities market, but for global goods trade in general, they're quite small. They only account for 2 to 3% of global trade. However, they have a huge presence in particular countries, especially those in Eastern Europe, the South Caucasus, Central Asia, as well as the Baltics. But they also play a really key role in global value chains, which I will refer to as GVCs. And these are already under strain, immense strain from the pandemic. Globally, since Russia and Ukraine are large exporters of commodity inputs, which go into the upstream side in many global value chains, shortages of their commodity exports could severely affect a wide range of industries, including food, construction, petrochemicals, and transport. Russia's role as a major supplier of commodities places it at the foundation of a wide array of global production. Russia is one of the largest suppliers of energy, medical, and chemical products. All these products are used on the early side of GVCs, that is, their upstream. And Russia stands out in particular largely for its high forward GVC participation, while Ukraine also has high GVC participation, but it's both forward and backwards linkages. And the GVC production hubs, large ones, for instance, in China, Germany, and the United States, are among Russia's largest trading partners, both as importers of Russian commodity inputs and as exporters of GVC goods. But the integration of Russia and Ukraine into global value chains extends beyond commodity linkages. I spoke earlier about Ukraine's importance in European auto industry, but there are other disruptions that can cascade through beyond their bilateral trading partners. For instance, the production of neon gas, which is an input into manufacturing of silicon chips, is concentrated in Russia and Ukraine. This is likely to be interrupted, and this could compound silicone chip shortages, which has already caused supply bottlenecks further downstream in automobiles and electronics. Protracted shortages of metals exported from Russia, such as palladium and nickel, will increase the cost of items, including catalytic converters and batteries. And disruptions of exports of potash fertilizers from Belarus, which is also under sanctions, as I mentioned, will affect food production elsewhere, especially in Latin America and the Caribbean, and exacerbate food price increases. So in the near term, there is limited scope for these downstream producers to substitute alternative inputs. These things take time. And, the initial shock in Ukraine, Russia, Belarus is therefore expected to quickly amplify across sectors and borders, magnifying the impact of the war on global production. So again, just because they aren't a large share of global goods in the global economy, they are very critical for global production processes. And turning to the financial markets, we saw global financing conditions were already tightening before the war. And this is largely on the expectations of policy normalization in advanced economies, especially in the United States, for instance, where inflation had kept surprising on the upside. Well, the war has accelerated the tightening of monetary conditions. At least that's what the market expects. So turning more to the regional side, immediately following the invasion and the announcement of international sanctions, we saw the Russian ruble depreciate sharply. It forced the CBR to raise its policy rate, to double it, in fact, to 20%, impose capital controls, and provide bank liquidity and broad forbearance measures. And financial markets and the banking sector did subsequently stabilize from these measures that were put in place. And this allowed the Russian central bank to bring its interest rate at least back to 17% from 20%. The stock market had been closed for about a month. It has reopened in late March. And since reopening, the authorities have intervened in order to curb volatility. They did this by largely restricting investor activity, including through measures that limit trading to certain securities, bans on short selling, and non-resident trading. So they've really been propping up the market and the ruble. But more broadly across ECA, financial turbulence has eased somewhat from this initial invasion point. And so the markets have stabilized, albeit at higher levels. So external financing costs are still higher than they were before the war, but things are relatively a lot calmer than they were than the 2 weeks after the invasion. And of course, this is a big risk, right? It doesn't take much for financial markets to react, and uncertainty and geopolitical risks are certainly elevated. So we could see this, unfold again and cause some financial pressures to resume. Now, sanctions so far on Russia, on their financial system, appear to have had a modest spillover so far. A lot of the banking system in Europe, they have limited exposure to Russia, but of course, further analysis will be needed. There can always be, you don't realize it until the trouble comes up, and then you have balance sheets that are impaired. So we don't see any of that yet. So that's the good news. And we're looking carefully, though, where Russia banks in particular play a large, important role, such as Belarus, Kazakhstan, Tajikistan. That's where we might see this impact. And of course, there's always longer term concerns from these sanctions, that countries might start to develop their own SWIFT networks. There could be greater fragmentation and possible diversification away from dollars. So there's a lot of things to keep an eye on. And then very quickly, so we can move to the forecast side. So obviously, Russia plays a really large role in financing in the region. It has all these historical and economic ties, but it's also a really critical source of income for the region, especially in the case of remittances. We see in Kyrgyzstan and Tajikistan, for instance, that they are approaching 30% of GDP of remittances from Russia alone. So huge risks there for household income. And then not only that, Russia and Ukraine are important for a source of tourism for many regional economies. Transit disruptions, including from airspace restrictions, are likely to dent services trade in the region, as tourism from Russia and Ukraine can account for more than 10% of all tourist arrivals in about half of the region's economies, including those that really rely on tourism for their GDP, such as Georgia, Montenegro, and to a lesser extent, Turkey. So this is something we are carefully monitoring. And, tourism inflows were already struggling because of the pandemic. So this is just another strain on these economies. And then, of course, as mentioned earlier, the war is causing devastating humanitarian crisis, which is spilling into neighboring economies, particularly in Poland, who has received millions of the refugees. Yet at the same time, the influx of Ukrainian refugees and Russian migrants could pose an upside risk and have positive effects in the near term on domestic demand in some of these ECA neighbor countries, and in the medium or longer term on economic growth by expanding the labor supply. As you may be aware, with the ECA region, labor supply demographics are a key constraint to potential growth. And so boosting the labor supply could lead to a positive boost to the economy. For instance, the previous wave of Ukrainian migrants to Poland over the past decade or so helped alleviate demographic pressures and bolstered the Polish growth rate by an estimated 0.3 to 0.5 percentage point per year, according to academic studies. So there could be some upside for ECA economies. Of course, this is bad, terrible news, though, for Ukraine and for Russia in particular. And so we put all this together to try to make it as visually digestible as possible, to get a sense of what the regional exposures are from this conflict, from this war. And as you can see here, Central Asia and the South Caucasus are particularly exposed. But other parts of the region are too, and for specific areas such as energy and tourism. So this is why we're expecting some economies to really, really struggle, which you can see here in our growth table. So Again, before the war, regional output had nearly returned to its pre-pandemic trend at the start of 2022. But the war has reversed its recovery, unfortunately, with output in 2022 now forecast to contract by 4.1%. This is 7 percentage points about of a downgrade from our January forecast. In addition to Russia and Ukraine, 4 other ECA economies are expected to shrink this year. Belarus, which is under sanctions as well, the Kyrgyz Republic, Moldova, and Tajikistan. And these are countries that are suffering from the greatest spillovers. Most of the rest of the region, though, is expected to grow, but at anemic rates. Central Asia and the South Caucasus will be especially weak, and this again largely reflects their close economic linkages to the Russian economy. Excluding Russia and Ukraine, ECA GDP growth is expected to grow only slightly faster than 2% at 2.2%. This is well below their potential for the region. So this is very weak growth. And across the board, growth projections for 2022 have been downgraded due to these spillovers from the war, weaker than expected growth in the euro area, tighter than anticipated macroeconomic policy, especially given rising inflation, and commodity and financial market shocks. The baseline projections are based on assumptions that the war in Ukraine persists in the near term, but becomes perhaps a bit less intense over time or more localized to specific parts of the region. The assumptions are also hinged on policy and geopolitical uncertainty remaining high in the region, and that sanctions remain in place throughout the forecast horizon at the very least. We also expect that the region is going to continue to face a tougher global economic environment characterized by tighter global financing conditions, softening external demand, and these lingering supply chain bottlenecks, which some of the strain is now coming from this war. However, if the war escalates such that Russian energy exports to Europe are disrupted, regional output could be far weaker, which is something that we modeled in our downside scenario. And so, obviously, going into this report, we knew the regional outlook would be subjected to considerable uncertainty due to the war, much like how it was when COVID erupted. And its impacts on the regional economy and the euro area are also subject to great uncertainty. So we decided to construct a downside scenario. So although Russia accounts for about 40% of regional GDP, the regional linkages for trade, financial channels are actually much stronger with the euro area than with Russia. And so we constructed this downside scenario where GDP growth in the euro area is slower by 3 percentage points in 2022, reflecting the impact of commodity price shocks from the escalation of the war, which I just talked about. In turn, this would trigger additional sanctions or somehow interrupt Russia's exports to the euro area. This is our downside scenario assumptions. And so we also assume a shock to financial confidence, as well as a doubling of the contraction in Russia to 20% this year and a 75% contraction in Ukraine. In this downside scenario, you would see ECA growth fall to 8.7 or contract by 8.7% in 2022. This is about 5 percentage points sharper than the baseline forecast and almost 12 percentage points lower than the pre-war projections. In an output contraction that's steep at nearly 9%, this would be far sharper than the one experienced during the global financial crisis and the one induced by the pandemic in 2020. So things could get worse, is what I'm trying to say in short here. And of course, why do we care about these growth numbers? For the poverty impact. So certainly the increase in poverty rates will largely stem from Ukraine in the region. As I mentioned before, Ukraine is facing refugee, internally displaced, millions of people. About a quarter of the population is displaced. And in Ukraine, we modeled what the growth effects would be on poverty rates. So using the typical poverty threshold for the ECA region, which is at $5.50 per day, we expect that poverty is going to rise sharply in Ukraine from around 2% in 2021 to nearly 20% in 2022. And these are based on simulations, again, using the latest macro projections. But on top of that, an additional 60% of the population are vulnerable to falling into poverty. So this could be really detrimental. And in the rest of the region, economic contractions, which we are expecting in about a quarter of ECA's economies, combined with rising food and energy prices and decreased remittances, is also likely to push up poverty. And especially on the food side, we have modeled 7 ECA economies and what the impact would be if grain prices persist at the levels that they are. And this could increase poverty in these 7 countries alone by an average of 3.3 percentage points, or about 1.2 million people. And in all, we could see about 13 to 15 million people fall into poverty in the region from all these combined effects of the pandemic, higher prices, and the war. So this is quite a dire situation. But as I mentioned, things could always get worse. We have lots of downside risks to the ECA outlook. Despite this gloomy situation, other downside risks could materialize, including those related to a worsening war, financial stress, a de-anchoring of inflation expectations, and of course the pandemic is still there and lurking. Especially, this is a risk for countries that have not been as successful at vaccinating their populations. So these are the risks that we are looking at for the region. And of course, there's always the long-standing long-term challenges and priorities for policies. I've already been talking a long time, so I'll just quickly say that behind this backdrop, the critical priorities relate to nurturing macroeconomic stability to help countries be able to support economic activity in light of all these external headwinds. And over the longer term, it'll be key for ECA's longer term recovery to promote an inclusive and sustainable recovery in order to keep that momentum going for generations to come. And Mr. Omori, I would gladly turn the floor back over to you. Thank you.
Thank you very much, Colette, to share the main point and findings from the latest edition of the Europe and Central Asia Regional Economic Update, which was just released like 10 days ago. Okay, we received several questions from the audience, and I'd like to read those questions, asking Colette to respond. First, several questions that we received from the anonymous participant as usual. Thank you very much for sending your questions as usual. First one, as described in the heat map of the exposures in the region slide, Central Asia, Eastern Europe, and South Caucasus are more vulnerable than other regions because of the linkage of the economy and people's migration. How does international society contribute or find alternatives to these trade, investment, and remittances without negative impact to other developing countries? Colette, if you would like to respond and make a comment to this question, please.
Right. So it's a very challenging time, as you mentioned. Not only are these economies now going to face a challenging external environment from reduced trade flows, reduced remittances, other spillovers from the war. But on top of that, they entered this crisis with depleted policy space, high debt loads, rising inflation. So this is a critical turning point. And so what I would say is that, and this doesn't even just apply to the South Caucasus or Central Asia. This applies really to a lot of countries, even within and outside the region. It's that really examining fiscal priorities and ensuring that spending is well targeted and that you're really supporting vulnerable households. And helping these client countries be able to do that will be critical. Applying means-based testing to identify these households. ECA countries, they have pretty fairly good capacity to do this type of specific targeting spending. So to really make use of what limited space there is and helping them on the policy side, identifying programs and policies that help boost not only near-term growth, but longer-term sustainable growth. That'll help, create resilience in its economy. Many of these economies suffer from, a large state presence, from a weak private sector, some shallow, domestic finance. So really broadening economic policy in order to help encourage private sector development. To make the state footprint, if it's going to be large, have it be effective. Putting in place policies that help, improve transparency, government effectiveness. These are all really good measures to take anyway, and will help, though, these economies deal with the ensuing storm. And diversification is always a good aim, not only just with the types of goods you're exporting, but building regional integration, with other regional economies, expanding, the branch. It's very tempting in times like this to, look inward, but really expanding networks, trade, financial networks, and integration, which is already, for the region's already very well connected into the global economy, but further expanding that could only help build some resilience there.
Thank you for your responses. Let me continue with another question from the same participant. Recommendations written in the slide long-term challenges and priorities are also ongoing and current need. What is your concrete plan, or what the World Bank's concrete programs for overcoming these challenges?
Right. So if you are interested in delving into the country, so there's not a one size fits all, right? For each country, there is a program, a nice set of policy measures that will help these countries maximize their growth potential, reduce poverty, address these lingering structural issues. And so I would highly recommend looking at the macro poverty outlooks for the specific countries to delve into the more fine-tune policy measures. But again, getting back to what the region as a whole really needs. Potential growth in the region is quite low. And a lot of this reflects lingering structural issues, the incomplete transition to a market economy, the issue of a large state footprint, underdeveloped private sector, a large presence of public administrative jobs. There needs to be more breathing space for the private sector growth, so jobs can, we can create more private sector development in the job sector, especially that aren't just tied to the public sector rather. And so there's a lot of these kind of low-hanging fruits that still hold the regional economies back on the potential side. And also, I'd like to say that other kind of generic policies that you could apply to a lot of countries in the region is, again, this diversification of trade. The region has quite a few commodity exporters. That is where their baskets of exports are dominated by a few commodities. And that leaves them really vulnerable to commodity price volatility, for global commodity price volatility. So looking to develop into their domestic production side and other areas could at least help these countries grow in a way and that they're not dependent on or so dependent on external factors that they don't have control over. I'd like to point out, for instance, you know, we see this in Central Asia, which is one of the subregions of ECA that's being really affected by this war. And you can see the difference in the economies that have taken strides to do reform progress over the past decade or so, diversification. Those economies aren't expected to contract this year. For instance, Uzbekistan is still expected to grow. Whereas other economies where the structural issues are perhaps more challenging, those ones are expected to contract. So really, it's not any new advice, but it's still good advice. So that is what I would recommend. For country-specific details, I highly recommend checking out the macro poverty outlooks.
Thank you for your responses. Next question from Mori-san. Thank you for your question as always. Slide 17 says that the poverty rate for 7 countries could rise by average 3.3% due to the food prices. Should we shed a light on the most vulnerable people, including people with disabilities in the ECA region? And what are the most urgent needed actions to help them?
This is a fantastic question. Thank you so much for asking this. I meant to mention the policy recommendation for this actually, so I'm really happy for this opportunity. So even though there are all these fiscal pressures that have built up from the pandemic, supporting the most vulnerable populations, especially given the sharp rise in food prices, and helping these households avert falling into poverty will be critical. Now, what to do about it in the immediate and near term? I would say that targeting these households for fiscal support is probably the most effective tool we have. It's also one we know how to do because we've done it very recently with the pandemic. And these policies tend to work a lot better and be more effective, more cost efficient too than other policies that might be tempting, such as price controls or energy subsidies or the like. So really being able to identify and target vulnerable households and provide fiscal relief to those households is a much better strategy than, for instance, putting in place costly, persistent energy, food subsidies, price controls, that sort of thing, as tempting as those are. So that would be the most near-term solution in my view.
Thank you. Related to the vulnerable population, would you please be able to make a comment on, the aspect related to the gender in the region?
Right. So as I mentioned, most of the refugees fleeing Ukraine are women and children. So this is definitely an angle we, need to be considerate of. First in the near term, ensuring the safety of these women and children, setting up safety passages and corridors, which the United Nations has helped implement in host countries such as Poland and Romania and Hungary, if I'm not mistaken, to ensure the safety of their passage, because they not only need to be able to flee the war, but they also need to be safe in their home countries. So helping host countries to be able to not only, you know, absorb, support these refugees, but also keep them safe. So it might require some multilateral collaboration and assistance in terms of supporting these host countries that are dealing with a huge influx of migrants in order to not only ensure their physical safety, but their education, their health. We don't want anyone to suffer huge setbacks. And so, especially given that the pandemic has already delivered a huge setback to human capital accumulation. So it'll be really critical to help these host countries to be able to support refugees and migrants to ensure that we don't lose any further human capital and to ensure the safety. And now, as far as the gender issue goes in the region historically actually has pretty equal gender equality in terms of education, etc. It's a historical reason for that matter, but ensuring that that remains the case is critical. Ensuring that migrant households, refugee households, the most vulnerable, poor, low-income households continue to be supported not only through this crisis but in the crises to come is critical.
Thank you very much. And the other question is that often the digital development or technologies can be mentioned as a potential source of the growth, particularly in other regions. Where does the digital technology fit into the current situation analysis?
So, yeah, no, that's a fantastic question. And so there's some good sides of it in that case, also some areas where we could progress further on. But I'd like to point out on the good part is that one thing that the region has become better at is ensuring digital connectivity from the pandemic. And so, in fact, whereas before the pandemic, if this full-scale war had happened, perhaps even more children would have seen their education disrupted. I think it's the Ukraine's Minister of Education says that, I don't have the exact share, but a large share of children have been able to transition back to online learning in order to avoid this disruption. So digital connectivity, I think, is a huge asset of the region, especially relative to perhaps other regions, but it is really uneven. So even within some of your EU countries that are part of the ECA region, there might be really, strong digital connectivity, capability for remote learning, for remote working, but in more rural parts of even within the same country, that access might not be there. So it's important not only to look at the aggregate level of digital connectivity for a country, for a region, but also within country and making sure that all segments of the population have access to this. Because I think what we've seen through the pandemic is that it really helps build resilience, having that access. It's not a be-all end-all solution by any means, but it certainly helps. And for instance, in rural parts and mountainous parts, there might not be broadband. Might be high frequency or high internet speeds, or let alone internet connectivity. So building those out and improving that access could really help enhance the resilience of the regional economy.
Thank you very much. We received a question from the Professor Yoshino during the presentation. So let me read his question. High fossil fuel prices could accelerate the shift to the green energy much faster speed. Is there any policy by the World Bank to shift to the green energy? Any comment on this point, please?
Right. So I like to see every crisis as at least try to see any positives or opportunities where there might be. So for the ECA region in particular, as you may know, the EU has a huge initiative on green transition, investment, etc. So, but what is really key for a lot of these regional economies to be able to fully benefit from that, and this is a long-standing issue again, so this is nothing new, is absorption of these EU funds. And it's not just contained to just EU countries. Many Western Balkan countries are also expected to receive EU funds, which can be used for digital and green transition. And so really, enhancing the administrative capacity in these countries so that the absorption of these funds can be done in a more timely manner would be critical to help jumpstart this green transition and get it accelerating quicker. Of course, ensuring that prices reflect the market rates for fossil fuel use. The region has remaining quite a large fossil fuel subsidy in many countries, but these are really hard to dismantle when prices are high because it can tend to trigger social unrest, which we've seen in the region even as recent as January in some countries. And so it's really important to put into place and to dismantle certain policies at the right time. So perhaps when energy prices start to go down is when you want to look at removing fossil fuel subsidies. So now is not the right time for that, but in the future that could be the case. But for building on the green investment, taking advantage of these EU funds, boosting the absorption capacity, tapping into the World Bank and IMF on the financing side of this green transition will be critical. And just using your regional partners as well. You being very close to the euro area, not only as economically close, but as physical neighbors, also presents a lot of opportunities, and especially on the technology side. So yes, there will be, there's going to be a transition period, and in some cases it might be difficult, but there's also a lot of opportunity, I would say, and anything that countries can do to boost these opportunities by putting in place, a stronger governance, more effective fiscal spending, prioritizing spending on these types of tickets, these types of investment opportunities that boost your underlying potential growth could not only be key for the green transition, but a sustainable growth path. So I see there's a lot of opportunities. It's just we have to seize them.
Thank you very much for your responding to the questions that we received from viewers. Before wrapping up our seminar, any final words from you, including some of the early announcement if you have of forthcoming works, forthcoming analytical pieces. So if you have anything, please.
Oh, well, thank you so much, Koshi. I mean, you've been such a gracious host. I just really want to say thank you to everybody for tuning in. And of course, the World Bank, we have many reports ever coming out. And so for our forthcoming reports, at least on my team, we have some commodity market outlooks that will be released, the Global Economic Prospects Report in June. And I'd also indulge you to stay tuned for some of our analytical reports that we will be releasing in the coming years. So looking at some really big global macroeconomic topics such as potential growth and investment. So all things that are really key to sustaining a solid recovery. And thank you again.
Thank you very much. We had a pleasure of having Colette Wheeler, a senior economist in the Prospect Group of the World Bank, connecting us from Washington, D.C. this morning. Colette, thank you very much for joining.
Thank you again.
Great, thank you very much. Next week, we have 2 online morning seminars. First, we are going to feature the Latin America and the Caribbean Regional Economic Update, and our speaker will be Bill Maloney, Chief Economist for Latin America and the Caribbean region. This will start at 8 a.m. On Wednesday, April 27th in Japan Standard Time. And also, we are going to feature the commodity outlook, commodity market outlook, April 2022 edition, which was just mentioned by Colette, in fact. This will be issued on April 26th, And then we are going to have this seminar in a few days after the official launch of the report itself. John Buffett, the senior agricultural economist, is going to be our future speaker. This will start at 8 a.m. On the Thursday, April 28th in Japan Standard Time. So with that, I'd like to thank everyone for watching the seminar. Stay safe, stay healthy. See you next week. Thank you very much.